we start with the intros?
Yeah, I would agree. So hello everyone. Happy to have you on our today's webinar. My name is Tim Schneider. I'm the head of customer value here at Buynomics and previously worked with CPG companies also at BCG. And I will be really moderating the meeting today and answering any questions you might have today in the chat. And also, of course, happy to follow up via email if you have any more questions around working with Buynomics or our solution. And today with me is our co-founder, Dr. Ingo Reinhardt, who will be leading the webinar today. He has over 14 years of experience in pricing, has developed the Buynomics method, and is also author of several white papers around pricing, its evolution, and a very strong topic expert. So very happy to have you here, Ingo. But before we start with the webinar, quick intro to Buynomics or of Buynomics. So Buynomics is a revenue management and pricing solution which is developed to provide you with an holistic optimization and analysis approach, high predictive accuracy, increased speed to insight, and by all of that, basically with better profitability. If you have any questions around the Buynomics method, the Buynomics tool, feel free to contact me via email after the webinar, and of course, follow us on LinkedIn. And yeah, now basically without further ado, I would hand over to you, Ingo.
Thanks, Tim, for the intro. So yeah, let's start with the topic. So the name we gave this webinar is After Inflation, and I think most of us, hopefully, I think all of us agree that there has been massive inflation basically in the last year. And to me, like the most visual way that was manifested was when here in Germany I saw the €1 shop increased prices from €1 to €1.10. So that was probably they were probably the last company to switch prices, but it happened. So there was something real going on. And but the question is now what we hear with many companies that we talk to, not of course from everyone, but from a large number of companies, we see that some find themselves now in a somewhat different world, and some feel that they maybe have increased prices too much. Of course, this is not the case for everyone. And the question is, and that will be part of this webinar here today, is to discuss how to deal with this world and what are ways to dealing with that. And here we just highlighted specifically. So if the dollar shop, the €1 shop went from €1 to €1.10, they saw volumes drop. Should they now go to maybe €1.07, have a slight price decrease? Or should they do something like 2 for 1, so increase the number of promotions that they're running? Or should they not do anything or add further products into the existing price? So there are different options, and these are the topics that we want to discuss in this webinar here today. So maybe just as these things usually start with some data in the beginning. I think what we saw is we just pulled these numbers recently. We saw high inflation here with a focus on CPG categories and a highly differentiated price increases across categories, ranging here from 17% price increase in pet care to almost no price increases for seafood and meat, for example. And what's interesting, I think everyone who's into numbers in our field notices immediately, if you look at the increases, the percentage increases here with pricing and the volume, there's very little correlation between the price increase and the volume change. So that's something interesting. So the effects are very specific to the individual category, and that means that we also need to study each category very specifically. And what we said is, and what also the initial example with the €1 shop indicated, is that we've seen very strong increases, and these are the increases in costs, costs for producers, so the ingredients and so on, as a price index. So there was massive increase already in 21, also in 22, and then we're seeing now, essentially since the end of last year, that the trend is sort of broken. It's not going up much further, and in many cases we already see a decline in the cost. And of course, the question is, what do we do with that? What does it mean for us pricing professionals? How should we be dealing with these effects? Maybe just a little bit background on inflation. I think from what we're seeing is that inflation has effects on all kinds of things that are relevant for us in pricing, revenue management. It obviously increases the cost of our products. That's, I would say, in most cases, the most immediate effect. But it also affects what our competitors are doing. They typically have similar cost structures, not the same, but somewhat similar within industries. So they will be faced with the same challenges, and they also typically need to change their prices or make some changes in their offer if the costs in a category increase. So there's something going on in our competitors. And also we see this typically not immediately, but after a while, that also consumer demand changes. What we often see in the cases that we look at is that in the initial phase, that was probably last year, beginning to middle of last year, is that most of the volume reactions that we could observe were very much in line with the immediate price change if you essentially stay on the same demand curve. So if you have on linear demand and you increase your price, then you see a decline in volumes, and that was very much in line with a stable demand curve. And what then happens, of course, differently in different categories, is that some cases the demand curves of consumers, of shoppers, switched for different reasons. If you have, for example, in Germany with large increases in energy prices, people switch how much budget they have in certain categories, and that is then reflected in the price demand curve. So if the overall amount of money that can be spent by consumers in a category goes down, then of course the demand curve shifts downwards. If for some reason people maybe have nominal wage increases and now nominally have more money, then that leads to an increase, upward shift of the demand curve. So different things are going on with consumers, but we typically see that this doesn't happen immediately. Immediately, you have the immediate COGS changes that maybe are then reflected in end consumer prices. You have competitor price changes, which affect the sales units of everyone is immediately, and then only later you have typically maybe after 6 to 12 months also changes in consumer behavior, switch between sectors, and then long term in countries with sustained high inflation, Turkey, South Africa, Southern America, different countries, you see that essentially the inflation becomes systemic because companies have more frequent price changes, consumers or shoppers have more frequent wage increases. So, and then of course, if that's what you have in a country, it's much more difficult to get out of this inflation. But I would say that in most countries, this trend has slowed down a bit, and this is also what we saw initially on the slides. And the question is, what does it mean for us as pricing and revenue growth management professionals, and how to best deal with that? I think that the main effect that's taken place, and this is also validated by many discussions that I have with clients and with prospective clients in the field, and also many of the discussions I had this week at 2 conferences, is that when we, and this is a bit oversimplified here, that we came from a world where in the past years there have been somewhat fewer price increases. Inflation has generally been rather low. So most companies and most prices are not typically on the profit optimum, but they're also not too far away from the profit optimum. So it's been a bit stable, the world. And many companies operate within a couple percent of their profit optimum. What then happened is we saw, as we said, large COGS increases, large competitor price increases, and so on, and that led to something what we see on the right side, which is which Tim told me is not an easy graph to read, but I'll try to explain it. Is that if you look at the companies increasing their price from P1 to P2, so they have, because their COGS increase and they have expectations about what competitors do, expectations about how shoppers will react, they have increased their price from P0 to P1. And what we see up here are the profit curves, just as on the left side. So we have there's the first profit curve, and there's a second one. The first one is a world in which the profit optimum hasn't increased so much above P1 because competitors haven't increased their prices too much, consumers haven't increased their nominal willingness to pay, and so on. And that means if that all of these things come together, we end up in this left profit curve. If, on the other hand, competitors have increased profits, have increased their prices even more than what we did, if consumers have nominally increased their willingness to pay, and other things like that has happened that were in favor of shifting the profit optimum to the right, then we see this curve here, the profit curve on the right side. And in this case, we're underpriced. And I think the major message here is that we sort of moved from a not fully stable, of course, but more stable world to a less stable world, because there have been massive changes in everyone's COGS, and companies have reacted very differently to it. And now we find ourselves in a world where more products are priced further away from their profit optimum or revenue optimum, depending on what companies are aiming for. And the question is now, what do we do with this increased uncertainty, and where do we actually find ourselves? And I think a good way to think about it is this here. Let's say if you are too expensive, and too expensive doesn't just include, I would say, the price, but it could also mean that you are running too few promotions, or that you haven't added enough value to your product. So everything that leads to your offer being too expensive, what will you see then? You will see typically a stronger increase in price elasticity. If you increase your price by a lot, and your demand curve hasn't shifted, then this typically leads to a very high price elasticity. For example, if you have a linear demand curve and your current price elasticity is -2, you increase your price by 10%. Your new price elasticity after the 10% price increase is somewhere around -2.7. So that can be a substantial price increase. And if you increase your price more, then the price increase also increases by more. So this is typically an indication of having had a large, or maybe in some cases too large, price change, is if your price elasticity has increased massively. What you will also see is if you have increased your price more than others, obviously, that your market share tends to go down, so you find yourself with a reduced market share. But what you also see is you will have typically high percentage margin, but also typically suboptimal profit, which is not always detectable. Many companies have increased their profits over the last year or half year. So they have increased their margins in percent, they have grown their profit, but they now operate below their optimum. So that's what happens if you're too expensive. Likewise, if you're too cheap, you tend to still have rather low elasticities, but you also have low margins because your COGS increase and your profit is below the optimum. And I would say typically, considering how it's perceived by the organization, you're probably in more trouble if you're in the lower world here with the too cheap prices. So what can you do? I think we have three primary levers to deal with this. Obviously, if you're too expensive, one option to think about is always to reduce the price, or if inflation continues increase at a slower rate, you can change your pack price architecture. That means you can add further value to your products, for example, or you can work with your promotion frequency. If you feel like you've been too expensive and you've lost market share, one way to deal with that is increase promotion frequency. And likewise, if you're too cheap, you can do the opposite. And this is what we want to look into. And to get started, we start with, I would say, a very simple example, just as a refresher on the basic dynamics, how this works. So just for simplicity, let's consider we have an exponential demand function. Don't need to worry too much about the formula here, but what we need to know here is that if we have an exponential demand function, then the price elasticity is constant. So for example, always -2, -1, -3, whatever the number is, but it's always constant regardless of how we change the price here. This doesn't appear in reality, or much less in reality than it is present in textbooks, but I think it's an important case to illustrate the point here. So, and if this is the case, then we see there's a simple relationship between price and cost. And that means if we know the cost and the elasticity of a product, and there are no interdependencies, as we only look at one product here, no dependencies, then it's really easy to compute the optimal price if we know the COGS and we know the price elasticity. So for example, if price elasticity is -2, we have costs of 100 euros, then the profit optimal price here is 200 euros. And an easy way to see that, to validate that, is that in the profit optimum, margin times price elasticity is always -1. So at a price elasticity of -2, your margin should be 50%. Very easy then, if our costs increase from 100 to 110, then our new profit optimal price is 220. And now I think maybe some in the webinar feel that their blood pressure increases. With the same logic, if the costs go down from 100 to 90, your profit optimal price would be 180. So you would, if this is the only thing you're looking at, this would mean to optimize your profit, you should also reduce the price. I know that this is a very simplistic, this view, but this is, I would say, essentially what the math suggests is the right thing. Of course, in the real world, where there's more than one product and we have competitors, there are many more things to consider. For example, that if you increase your price because you overshot in the previous quarter and you reduce the price, there might be a competitive reaction. It might trigger a price war. These things need to be considered. What also, of course, needs to be considered is how strong the memory is of people of what the prices of products are. So if people notice that you reduce your price, this can have some implications. People might question the quality of your product. I think one of the most present discussions of price decreases in the past months was the case when Tesla decreased the price of their vehicles. There was a lot of discussion, but I think beyond that, I think it's something reasonable to think about. And in industries, many industries, something like if you buy petrol for your car, you have price increases and price decreases many times a day. So in industries where that's established, it works and it makes a lot of sense here in terms of the mathematics behind it. But of course, it's important to understand what the implications are. But it's certainly one thing to think about when the COGS go down, that you also decrease your price. But it's not the only thing you can do. There are more things that are relevant. And I think, as we said earlier, a couple of minutes ago, is that other alternatives to reducing the price are increasing the value. and also, for example, increasing the frequency of promotions. And I just want to show you the differences between these approaches. Of course, with basic microeconomics here, the focus is always on the price because it's somewhat difficult to evaluate what a promotion change would look like in a price demand graph like this, or what an increase in the value looks like. But let me just switch my screen for a second, and I will show the differences. Tim, can you see my screen?
Yeah, very good.
Okay, let me just move these things. All right, so here's a super simple example, just to highlight the basic effects that we're talking about. So we're selling apples, and our costs are 50 cents. The list price is 1.30 in this case. I think it has been like €1 or €1.10 in the past. We've increased because our costs increased, and our competitor is selling peer. So it's a super simple example of an industry. But it already highlights the dynamics that are relevant here. And let me show this. So what we can see here is, so it's a small market. So we're selling maybe in front of on our lawn to people who were walking by. We're selling these apples 1.30, and our neighbors selling at also at 1.30. We sell about the same, willingness to pay for it. Each one is very similar. And what we can see here in these dynamics, so it's an example market, so it's super simple. This one's not based on a real example, but I'll just show you afterwards something else that's a bit more complex. But this here is useful for the basic dynamics. So what I did now, let's say if I increase the price here by 10 cents, I would lose another 49 units, and my competitor gets about half of that. And then there are some people who will not buy anything anymore. Likewise, if I reduce my price, I will gain, and about half of that comes from my competitor, half of that comes from people who didn't buy a fruit previously. What I also see is something like the price elasticity, and I also see, let's say if I increase more, that this of course changes. It's, as I said before, it's only constant in textbooks, but typically not in reality. And what I can see now, when I look, these are the demand curves, these are the profit curves, that I'm a bit, if I'm at a price here of 1.30, that I'm too expensive in this case, right? So if I'm at 1.30, I'm too expensive. And actually my profit optimum is here at €1.10, right? Doesn't make my competitor optimal. He's now way off the optimum. So in this case, when I'm at €1.10, my competitor should be at €1 to be profit optimal, but we'll ignore the competitor for a minute. So what happened is, just to summarize the situation, we had a COGS increase. We both increased our price to 1.30, and now it appears that that we are too expensive. And the question is, what can we do with that? So one option, and I won't go into too much detail looking at the time, is of course, let me just take this base case where we started. So these are our sales. If I also include the competitor, about equal sales. And this is just one option, if I now reduce my price and to 110, competitors still at 130, I will gain sales somewhat, some of them from my competitor, but also some from competition. But there are other things I can do. So one option would be that I think about introducing a promotion, right? So, and here I say in 30% of the time, so about every third week, I sell apples at €1, and the rest of the time I will still sell them at 130. 2 weeks 130, 1 week €1, and then these are the units that I would sell in this case. Another option could be that I say, okay, I don't want to change the price. I don't want to work with promotions. but I have the option to sell larger apples. So I think about increasing the value of my product. And because the apples are larger, I'm still selling at the same price. I'm winning sales units in this case. So this is just to highlight some of them. And this is the view on units. You have the view on revenue. And you can also look at the view here on profit. And you see then that in this particular case, if I just look at myself, that the large apples are a bit more profitable than the simple price increase. And here, I think in this case, the promotion was a bit expensive. Adding the promotion doesn't increase profitability. So this was just to highlight how to work with these things. And this is our solution, the solution that Tim mentioned in the beginning that we're building at Buynomics. And you can, of course, not just look at these simple examples, but you can also, of course, look at much more complicated examples. So this is still a simplified one. The one Tim is working with are much larger, many dozens and hundreds of products across different channels. But with these dynamics that we just highlighted with the Apple example, you can cover the full complexity of real businesses across channels. And you then see all the interaction between these different products and how they react to differentiated price changes, changes in products, anything that's relevant. And with that, I would go back to the presentation and just summarize what we've done, and then we'll take some questions. So I think what we saw is that we saw high inflation, and in some categories more than in others, but generally high price increases. And that, of course, because of the increased complexity, led to the case that some products were increased more than they should have, some were increased less than they should have, and that means that many products are now further away from their profit optimum or revenue optimum or market share optimum, whatever companies are aiming for, than they used to be. And this increases the complexity because now, as a second move, it's much more difficult to anticipate how changes affect the marketplace in this much more dynamic world. And I think this is the world we're living in many categories, in many markets, not just CPGs, but across industries. And the question is, and what we see is one of the key needs here is a need for the ability to have transparency on what happens in these markets, and the ability to predict very precisely how price changes or other changes affect sales, revenue, profitability, and all the other KPIs that are of interest. Thanks for listening, and I hand over to you, Tim.
Yeah, thank you very much, Ingo. So coming to the questions now. So I think we have a first question here. The question is it possible to add competitors' data from other sources like GfK or Nielsen in order to not do it manually?
Yeah, so I would say in general, the solution here works with all the typical data inputs or insights, be it actual sales data or transaction data or survey data that are typically used for pricing and revenue management. I think what's also useful that we do, and Tim has probably more details on that, is that the solution, of course, there's always some uncertainty on knowing how competitors will react in the end, but there are typically two answers. One is looking at past behavior. You typically see a pattern in how different competitors price. Do they just follow you or someone else? Do they always increase with inflation without looking left and right? So there are patterns in how certain companies typically operate. And the other is with this, we haven't touched it a little bit in the Apple example, is that that you can easily look at different scenarios. And you can, for example, look at different scenarios where you say, okay, we have range of scenarios from competitors will not do anything at all. They will just keep their prices, which is very unlikely. Two, they will, I don't know, do the same that we do or even more. And then you typically have a range of alternatives and can see how different actions do across a range of alternatives.
Yeah. And maybe also to add on this one here, so I think the essence of the question is around basically if we can also implement data from competitors that does not come from JFK or Nielsen. And like here, the general answer would be yes, of course, it needs to be structured and more or less similar to the data that you have for your own products. So I hope this answers the question. Then we have another question coming in. So the question is basically around the cost increase. So the costs went up in Q3 and Q4 2022 from what we saw. For 2023 and 2024, is it a slight drop, or we are in a new level of costs, or are we in a new level of costs? Yeah, I think this is around COGS increase question.
I think what we saw in the graph is that they were going down. Of course, this was an average, and in some categories they're going down, and some others they're not. But I think the general observation is that COGS are not increasing as much as they were last year. And the question then is how to deal with that now that companies have made price increases that in some cases were too high and in some cases were too low. I don't think we can predict how COGS will increase or change in the future. This is not what we do, but I think it's our field and the solution that we build start where you have an expectation about COGS changes in the future.
Yeah, correct. Good. And maybe last question. So overall, what data do you use to fuel the Buynomics model? Yeah,
probably Tim, you can always answer that better than me. But I think what I mentioned before is in general, the tool works with all the data sources that are generally used for pricing, revenue management, ranging from transaction data, sell-out data, to survey or panel data. And I think what's neat about it is that they can be very naturally integrated. We haven't talked much about the technology that underlies the solution. We just looked at the result, but the core is what we call the virtual shopper model, and that's something that we developed. And the idea is to create a large number of these virtual shoppers that collectively behave like real shoppers, and their behaviors and preferences are parameterized using different available data sources, like the ones I mentioned, transaction data, sellout data, but also panel data, and they can all be integrated, right? So you could, for example, have a robust model using historical data, and that's then integrated with survey findings on a new brand that you want to test, or a new product feature that hasn't been in the market. So this is how it can work. If you're interested in more detail, we're happy to. We're available to discuss this in one-on-one.
Yeah. Yeah, I think as exactly what you said at the very end, most important is that we can combine also these types of data sources, like the historical data, as well as like survey data. Very good. I think then we are through for today. So thanks everybody for joining today's webinar. Please follow us on LinkedIn, and of course check your emails for the next webinar. I think it's going to be interesting. Maybe you want to. Yeah, and we have a couple of webinars coming up. Of course, so the next webinar is pricing and revenue management method. I think very interesting webinar, so I can highly recommend it for everyone. And then we have another Buynomics Talks episode coming up. So the second one in our basically in this format with Ulrich Lerskov-Schmidt. So it's going to be very interesting with Ingo together.
Definitely. All right. So thanks, everyone. We're a few minutes late. We wish you a happy weekend. Good end to this week, and looking forward to seeing you in our next webinars.
Thank you very much. Bye bye.